is the Bloomberg Surveillance Podcast. I'm Lisa Abramowicz along with Tom Keene and Jon Ferro. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on demand on Apple, Spotify, and anywhere you get your podcasts, and always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app.
Been looking forward to this conversation all morning. Richard Clarida, the Global Economic Advisor at PIMCO and former Federal Reserve Vice Chair and a good friend of this programme for many, many years. Rich, wonderful to catch up with you, sir. I was thinking back to our conversation we had on the West Coast when PIMCO put out their secular outlook, and you and I talked about what you called the Fed tolerating 2-point-something. Did you hear that from Chairman Powell in that news conference yesterday? Because I did.
Well, yeah. I think that they've had a lot to do. They've done a lot of heavy lifting. Ultimately, they do want to get inflation to 2, but they understand that if a year from now it's running in the 2s, that will have been a big accomplishment, and they can adjust rates down. They don't, they obviously don't want to tighten too much. And so, yes, I think 2-point-something is kicking and alive for sure right now.
Rich, it's worth going over what they're basically telling us explicitly. They're willing to cut interest rates with inflation above 2%. How controversial might that be?
I think they'll do a good job explaining it. What they're going to say is, look, as inflation falls, if the Fed doesn't cut rates, it's actually tightening policy because policy is the real rate. So if the nominal rate's unchanged and inflation's falling, they're tightening, and they won't think they need to add additional tightening if they think the inflation momentum's going in the right way. So that's the way that they'll explain it.
The Fed was talking a lot about data dependency and how they really aren't giving forward guidance at this point. Did you get a sense of which data could really shift their views before September? Even though we do get a slew of data, we've heard every time them come out and say, one data point a trend does not make.
Sure. And I think so they'll have 2 more inflation prints and 2 more labor market prints. But Lisa, I've thought for a long time that another important development that they're going to be following is what's going on in the labor market. They like the fact that the labor market is buoyant, but wages are going up faster than consistent with the 2% target. So I do think they'll be looking at the labor market data, wage, employment cost index, as well as the price inflation.
So what would they have to see? How high is the threshold for them to hike again in September, or if not in September, in November?
I think it's maybe a closer call than some of the market pricing right now. They did write down 2 more hikes in June. We got one of them yesterday, and an overwhelming majority of the committee thought in June that appropriate policy would call for one more hike. So I think certainly one more hike is in play at some point in the fall. The chair said that explicitly. He also said that when he was in Europe a couple of weeks ago. So I don't think it's an overly high hurdle to get that hike. I don't think they necessarily have to do it in September. I will say this, whatever hiking they think they need to do, I think they want to get in this year.
Why this year, Rich? Why is that important?
Well, I think a couple reasons. I think that they think they're close to the end anyway, and inflation's moving, however slowly, in their direction. And I think they would like to stay out of the spotlight in an election year. Now, we've had the Fed hike in election years, 2004, 1984 come to mind, and they'll do that if they really think that inflation really requires a much higher rate path. But I think this cycle is aiming to finish up sometime in the fall.
You know that this Fed is always criticised. The committee always faces criticism for something. Some of the criticism we heard from some guest in the news conference before the news conference and after the news conference too was just how data dependent this Fed actually is. They took a break from hiking, Rich, then they come back and hike again. And in the intermittent period, we had inflation that actually improved. The inflationary backdrop seemed to get better, and yet they hiked anyway. How data dependent are they?
Well, good point. Data dependence is a very elastic phrase, which is open to various interpretations. I think on balance, really, going forward, especially after this meeting yesterday, they really are data dependent. As you know, I've said on your air before, most of this rate hike cycle, they've not been that data dependent. In March of last year, they knew 2 things. The funds rate was at 0 and inflation was at 5 going to 6. That's all the data they needed to set off this very aggressive rate hike cycle. I do think as we do get close to the terminal rate that at the margin is more data dependent. Although I agree, and I said on Bloomberg after that meeting, it was an awkward pause in June. That's for sure.
It's an awkward moment also right now, given that the Fed is removing recession as the base case, and we're looking at a soft landing. And yet there's a real question mark among analysts and a real split among investors about whether inflation could reaccelerate as a result of the strength, the resilience, the wages. Where do you fall on this? What do you think the Fed falls on this, given that they seem to be taking perhaps a bit more of a dovish stance?
Yes, quite frankly, Lisa, I was surprised in the press conference. I wasn't surprised to hear the chair say, as he has many times, that he thinks there's a path to a soft landing. That's okay. Sure, there's a path, but I was surprised that he invoked the change in the staff forecast. I don't think that was in the June minutes, and so he's obviously entitled to do that. But yes, not my base case, not our base case, but there is a scenario where we get some good news on inflation this fall because of falling rents, used car prices again falling. But if the Fed finds itself in March of 2024 with an unemployment rate of 4 and an inflation rate of 4, with some of that temporary good news behind them, they're in a very tough spot. So I do think it's a risk. It's not the base case, but it's certainly something, if I were still there, I'd be assessing.
What do you think right now is the bigger risk, Rich? The idea of inflation reaccelerating and still being a problem, or the idea of recession and avoiding something more entrenched, which could happen if the Fed moves slower?
Well, personally, I do think that, again, I'm in the private sector now. I do think that the Fed, the bigger risk is for the Fed is to declare mission accomplished too early and find themselves next year having to restart the rate hike. So if I were there, it would skew me to getting in, that additional hike this year. And I think some members of the committee will see it that way. Look, Lisa, the other thing is the Fed's own projection, which I agree with, has unemployment rate rising by about a point by the end of next year. That would be very modest. That would probably be the most modest downturn we've had. But historically, as we know, the Somme rule, whenever the unemployment rate rises by more than a half a point, it's ultimately declared a recession. So I actually think a truly non-recession outcome without any rise in the unemployment rate at all is going to be tough. That's my personal view.
Would be phenomenal if that materialized. I want to finish on this if we can, Rich.
Yeah.
No dissents. We talked about this yesterday. I've been talking about it for a while. You've been on the committee. Why do people, even when we know they might disagree with the decision, make the decision not to dissent? Why does that happen on the committee?
Well, the Fed has been an institution that's been around for 100 plus years, and there are certain cultural norms. And certainly it's been a very long time since you've had a governor dissent on a policy rate decision. If you go back to the Volcker years, he had governors and his vice chair dissenting. But, since Greenspan, but the Reserve Bank presidents can and do dissent. Certainly during my time at the Fed, especially in 2019, we had 3 dissents, and we had several presidents saying they would have dissented if they had had a vote. So dissents can happen. The other thing I should note is we've had a lot of turnover among the regional bank, district bank presidents. The announcement of Jim Bullard, recently Esther George, Charlie Evans, Rosengren. There's accumulated 50 plus years of institutional experience that's no longer in that room. I think that's also relevant.
Richard, thank you, sir, for weighing in. Let's catch up soon. Next time in studio, please. Richard Clarida there, the former Fed Vice Chair and now of PIMCO. Joining us now for a preview of the ECB, James Athey, Investment Director at Abrdn. James, much harder decision for the Governing Council and the European Central Bank. The Fed has the luxury of saying growth is good, the labour market's strong. Right now, I'm not sure President Lagarde can go into that news conference a little bit later this hour, James, and say growth is good. Is this a hard one for her?
Hey, John. I mean, you could argue it's a little bit easier because, again, the transmission for monetary policy to influence inflation is largely via demand. So, if anything, the ECB is facing a slightly easier task because they can see that demand and forward demand through things like the Bank Lending Survey are already softening and softening significantly, which suggests that their policy is further into restrictive territory, and maybe they can more convincingly consider the end. Whereas, as you guys were just discussing, if the US consumer doesn't die down, if the US labour market doesn't soften, it's difficult to believe that they've found equilibrium, and it feels like they would have to come back to the table. So the communication is difficult because we're moving from this very backward-looking policy stance into something highly data-dependent. Central bankers know that markets have a tendency to get carried away, and they don't want that easing of financial conditions. But that's a problem they cannot really resolve. I think we'll see a very similar outcome today. Non-committal, not really full of information.
Meanwhile, we've been talking about the bank lending transmission mechanism in Europe, and John rightly pointed out that it is more sensitive to this type of contraction, which we've heard and we've seen. What are you experiencing? What are you seeing on the ground in terms of how quickly credit is contracting in the Euro region?
Well, I mean, that's difficult to say on the ground. I think we all have to rely on the data as we see it. And I look at the contents of the bank lending survey, and I think more pertinently on the demand side than the supply side. Of course, supply conditions matter. They always do. But what matters for judging the stance of and transmission of monetary policy is more about the demand for loans, and we can see that really does look incredibly soft across the Eurozone. If you look at the sort of pre-pandemic estimates for neutral rates in Europe and the US, maybe 0.5% in the Eurozone and maybe 2.5% in the US. There's 200 basis points between them, but actually there's only 150 basis points between the cash rates. So that alone suggests that European policy is already tighter than US policy. And I do think we see that in the data. And that's without even getting to the structural challenges in the Eurozone.
We've got to talk about some of those challenges now. On the ground in Frankfurt, Germany, Bloomberg's Maria Tadao outside of the ECB headquarters. Maria, just frame how difficult this is going to be for the European Central Bank in 30 minutes' time for President Lagarde when she has to deliver that news conference.
Well, this is going to be a very difficult communications exercise for the head of the European Central Bank, because on the one hand, we know they will hike 25 basis points. That was the guidance to the market, and everyone is well calibrated for that. But the big question is what happens next. And you've talked about this range of data, some of it very soft when you look at the PMIs. And it wasn't just Germany this week. You also had significant downturns coming also from economies like France. We also had that London survey, which we know they look at, but then core inflation sticky. So again, the market will be focused on any guidance, any bias potentially in this decision, but I'm not sure they want to do that. If anything, the European Central Bank, you could argue, wants to go for the most neutral possible, the most options open. Look at the data, say we go back to VM, very data dependent, and look back in September where we are. So I think it's going to be a tricky exercise. There will be a lot of questions to try to get an indication of where they want to go, but I'm not sure she wants to do that yet.
You follow the speakers. We heard from Klaas Knot of the Netherlands recently in the last couple of weeks. The individual members of the Governing Council, the traditional hawks, Maria, do you sense from them that even they are unsure about what comes next after July?
Yeah, and remember, Jonathan, this was presented today, July, as a, quote, necessity for the central bank. When it comes to September, we've seen maybe it's now 50-50, maybe it's now an open call, maybe we need to look at the data. Again, they're waiting for new projections in September. So I think there's been almost a rethinking over the past 2 weeks. What I'm also curious to hear about is, and this will be, I'm sure, a question, is this idea of rate cuts potentially earlier than expected. That would be the worst case scenario for the central bank, to have inflation that is above target and get all this chit-chat in markets about potentially, because of the state of the economy, cutting beforehand. I'm also very curious as to see, can she shut it down and how will she push back against that idea?
We're about 5 minutes away from that ECB rate decision. Still with us, James Athey of Abrdn. And James, I'd love your take on the data dependency, the maximum optionality that we're hearing, certainly from the Fed, and as Maria was suggesting, from the ECB coming up as well. What data are you honed in on? Are you going to be trading more aggressively on data in a new way?
Yeah, I mean, that's unfortunately the game of investing. It really is John Maynard Keynes' beauty contest, much as I would like to look more heavily at the most forward-looking data. The fact of the matter is that the markets are still somewhat focused on the most lagging indicators, that's jobs and inflation. So I think some balance between the two is probably the right path to tread. I agree with Maria completely. The ECB really doesn't want to give a strong signal one way or the other. There is definitely persistent weakness across the manufacturing sector. That's much more significant in the Eurozone than it is in the US. We're now starting to see softening in the service sector as well, and that is good news. But of course, none of these central banks want to box them in. To nick Jon's words, they want maximum optionality. So some sort of obfuscation, constructive ambiguity is what we're likely to see. I think once these risk events are out the way, the market at the moment is in the mood to then run with the themes and the trades that it wanted to run with anyway. So I think we saw that in the US last night. Weaker dollar, risk on, probably lower yields for the summer. That's what I'm expecting, and I don't expect Madame Lagarde to necessarily put a hole in that this afternoon.
Do you expect the dollar to weaken and the euro to strengthen because of the US or because of Europe's actions?
Well, I think the dollar is weakening because it's become a bit of a self-fulfilling prophecy. The market always has a bias to want a weaker dollar because risk tends to perform better in a weak dollar environment. The market has been and continues to love the carry trade. That generally involves at least selling dollar as an intermediate step. But I look at the dynamics currently and it doesn't necessarily look like a weak dollar environment to me. US rates are higher than European rates. The European data is rolling over far more quickly. As a general rule, that looks like a reasonably solid dollar environment versus the euro. So we're marginally long the dollar here. We think already the market's got a little bit overexcited, but short term, as I say, the market tends to run with the themes it wants to. I think positioning is a bigger headwind medium term.
What's
you
new
see
about
what you
that,
wanted,
James?
right?
I know, it's always the way.
Everybody sees what they want to.
It's always the way. James, I just wonder, I know what investors want. They'd like a big easing program out of China. Do you think that's what policymakers on the Governing Council would like to see right now? Would that be welcomed by them?
Yeah, I mean, that's a really good question. I'm not sure there's necessarily a huge supply side stimulus from China easing aggressively. So that might actually complicate their picture, add to demand without an offset via supply. I think the central bank would like to see inflation closer to 2% by hook or by crook. And then they can worry about the balance between supply and demand and how stimulatory or how restrictive their policy is. For what it's worth, I don't think China's going to engage in the sort of massive stimulus we've seen in 2015, 16 or 2007 and 8. I think there's a lot of adjustment and fiddling around the edges. I don't think they're going to go back to the sort of debt-funded infrastructure investment stimulus that we've seen historically. So I don't think there's a massive impulse for Europe coming from China.
So far, lots of people would agree with you. James Athey, Investment Director at Abrdn.
Right now, I really want to get through what we're looking at in terms of, is it a soft landing or is it a head fake? And I'm pleased to say that we're joined by Vincent Reinhart, Chief Economist and Macro Strategist at Dreyfus and Mellon. Vincent, what's your take on the slew of data that we just got that really highlights both a soft landing and, on the margins, disinflation?
We probably heard it from Chair Powell yesterday. Importantly, he said that the board staff had taken out their forecast of a recession. And Mike noted that GDP wasn't a surprise to the Atlanta Fed that had an estimate of 2.4% growth this last quarter. Board staff invests a lot of resources in doing the same thing. So I don't really think that this morning, certainly from the national income accounts, was that much of a surprise. Big question is, does it make it more or less likely there's a soft landing? Sure leans that way, but it's one data point. That's what Chair Powell would say at this point.
What do you make of initial jobless claims? Second consecutive month that there's been an upside surprise, or at least a positive downside surprise. Basically, there are fewer people filing for unemployment than previously expected in the prior month. How does this confirm with the idea that we need a loosening labor market in order to achieve disinflation?
Yeah, so the other part of soft landing is no productivity, that we are getting very strong employment growth that is at least matching that in output. We're not gaining anything in terms of output per hour. Among other things, that means that wage gains are more serious because there's no cushion between what firms pay workers and what they produce. I think that, among other things, The main takeaway is tight labor market is fueling household income, and household income is supporting consumption.
Which is
hard to get a recession that way.
Which is a reason why some people are wondering whether this is somewhat of an uncomfortable rationale, that you're seeing strength in the economy, and yet the Fed is moving away from any forward guidance of further rate hikes. Do you think that this is a mistake, that there wasn't a greater indication to markets that the Fed did plan to raise rates again once in this particular year, considering that Rich Clarida earlier on this show said that he, if he were still on the Fed, would vote to raise rates again this fall?
Last guidance was that they would raise rates in the summary of economic projections. Chair Powell is pretty confusing. He wanted to assert very strongly that every decision is, every meeting is live, that every meeting is made based on the data. But in fact, there seemed to be guiding us to a slower pace of policy firming, 12.5 basis points a meeting on average. That sounds like a committee that is, number one, divided, and number two, pretty close to the end.
Do you get the sense as you look through this data that there is strength in the economy, that perhaps they're not really watching closely enough, that there does seem to be something that could reignite inflation later in the year?
So I think they're watching closely the data. They see the strength in the economy, and if you're Chair Powell, you're encouraged by it. He's never really had a hard landing in his outlook. I think that the extent that the strong data is coming from the labor market, it's got to be troubling. It's got to be reason why you have to lean toward more policy firming. And I think it does pose a fundamental challenge.
Are you concerned that there isn't more dissent, at least publicly, on the Federal Reserve at a time where, as you said, it was somewhat confusing, and it seems as though there's a bit of a herding cats type of trend going on there?
So I think we saw, the division in the committee just by the two press conferences in a succession. In the June meeting, the chair spent a lot of time talking about all they'd done was slow the pace, slowing policy, tightening, allows more information to gather. But this time it must have had a yellow sticky note on his talking point saying, say meeting by meeting, live, data dependent as often as you can. That suggests to me that he wants a slow pace of policy firming. So he's got optionality. May or may not tighten in November, but he's got enough restive colleagues saying, nope, every meeting is live. Go out there and remind everybody every meeting is live. That's a division in the committee. We'll see probably better in 3 weeks when we get the minutes.
In about 5 minutes' time, we'll get maybe a sense of what's on the sticky note, the yellow sticky note of Christine Lagarde. In the meantime, I do want to head back to Michael McKee, who's been parsing through all of the data. Mike, what stands out to you in the details, the fine line items underpinning GDP, underpinning durable goods?
Well, GDP, the interesting thing here is we've seen a couple of months where inventories and trade really affected the numbers, but not in the second quarter. They both subtracted about 0.1% from the overall number. They kind of offset each other. And the real strength was in business spending, up 1%, and consumer spending up 1.1%. So that makes up most of what we saw during the second quarter, and it does suggest strength. Government consumption was up 2.6%. That's down from 5% in the previous quarter. Non-defense spending, which was up 10.5% in this first quarter, was down 1.1%. So not a huge contribution from the government this time. It's consumers and business spending, the C&I part of C plus I plus G plus NX. And in terms of durable goods, it's just overall good news that there is some spending, but it did slow in the capital goods non-defense area. So we'll see what kind of contribution that we get from durable goods when we go into the next month. I think the Fed looks at today's numbers and has to change their forecast for GDP for the year at the September meeting. And the jobless claims numbers just tell the Fed that we're not going to see unemployment start to rise in the near future. So they may have to adjust those as well. And this is the kind of report, I guess, that keeps them on alert, not going to make them make a decision because we're a long way away from September 21st, but keeps them on alert for the possibility of having to raise rates again.
Thank you so much, Mike. Great synopsis there, especially as we start to see increasing momentum or at least stability in the consumer. Vincent Reinhart still with us. Vincent, how long can consumers keep spending like this at a time where we're seeing results from the likes of Hertz, from the likes of Royal Caribbean? That trend is still in place.
So a couple things. They still have the retained fiscal transfers they got in 2020 and 2021. They've worked down a lot of that mound, but they still have that saving. And second is we're generating jobs and wage growth is strong. That means they're getting household income. 2 points to what Mike said. I actually see a lot of the government in the GDP print, and that's incentives for capital spending. I think that's part of the reason capital spending was so strong, given all the green initiatives. Second thing, inventory is on the soft side. The closest relationship of business loans to economic activity is the inventory component. So some of the softening in bank lending we've seen might actually be demand, not supply and credit constriction.
And that's what we've seen over in Europe as well. It was a drop-off in demand, not necessarily on the supply side. As you parse through this, though, are you watching things like the student loan repayments? Is that going to really play a role, or is it really going to have to come from some, I guess, tightening further in a way that might be a little more disorderly?
So I think it's got to be the latter. I.e., at this stage in the monetary transmission mechanism, it's the credit constriction that Jay Powell is waiting for. It is going to be, the cumulative toll of the earlier bank runs. And by the way, quantitative tightening is actually starting in earnest only now. First year of the program, when the Fed ran off its securities holdings, the Treasury paid for it by working down its cash balance at the Fed. Just moved money from one pocket of the government to another. Now, with the Treasury keeping its cash balance at a high level, all the security redemptions the Fed is doing is going to be coming out of the assets the private sector holds. Quantitative tightening is really kicking in now.
We're just minutes away from Christine Lagarde giving a press conference. It's scheduled to be 8:45. However, there usually are a lot of photos and introductions, so it may be a couple minutes after that. Vincent Reinhart with us of Dreyfus and Mellon.
Meta up by close to 150% year to date before these earnings. After them, we're going to go through that level. Meta right now is up by close to 9% in the pre-market after beating estimates and providing guidance that there may well be more to come. Mandeep Singh joins us now, senior technology analyst for Bloomberg Intelligence. Mandeep, wow, they got it done. And the question I think lots of people are asking at the moment, is that just cost control, or are we seeing a re-acceleration in revenue growth? I spoke to an analyst later on yesterday who said, we're expecting the latter. Are you seeing the latter?
I think so. And look, it's both. Cost control is the primary driver of why the stock has run up so much, because the margins are trending in the right direction. But with inflation pulling back, it's good for ad spending. And that's what we saw that, from Alphabet. I think Meta was no exception. The one thing both these companies seem to be doing right is the pivot to AI and how they are using it to improve their ranking and recommendations in terms of the content that is being viewed on the apps. And that's what Meta called out yesterday. It's driving engagement in their Blue app, which everyone thought was a declining business. Well, it grew. And I think that is what AI can do in terms of driving that content engagement, which is the pull, really, to drive impressions. And, in an ad business, that is what matters.
Elisa mentioned earlier that Facebook notoriously is very good at copying other people.
Yeah.
Cough TikTok and Reels. How successful, how sticky has that product become?
So one data point they shared last night was Reels is now a $10 billion run rate business versus $3 billion last fall. And that just goes to show 3x.
Wow.
In a matter of 3 quarters. I think that just goes to show the point that, yes, they're very good at incorporating new features, but I do think it's going to cannibalize their existing ad inventory, the high-priced ad inventory, which is why in the print, the only negative I could find is the ad pricing went down 16%. We saw that from Snap. It was down 12%, and we thought it's a social media problem. In this case, they're actually cannibalizing their own ad inventory because Reels doesn't monetize as well as their other formats.
Of course, if you own the world and you earn a little bit less off of everything, you're still earning a lot of money. How much are we seeing them consolidate market share for the ad business versus simply just organically growing? In other words, is their gain someone else's loss?
Well, so look at messaging. Messaging, no one was able to monetize till now. Now messaging is a $10 billion run rate business for them, and they talked about incorporating AI agents. So the customer service use case for WhatsApp is huge. Again, we are still very early on, but the fact that they're talking about running digital storefronts who can do their customer service through WhatsApp AI agents, I mean, the market gets excited with these kind of things. And
can I just tell you, Jon? I get really frustrated when you go to a website and then you look for a phone number and there is no phone number. They're just chatbots. And then you discuss with the chatbot and they help you not at all.
I don't speak to the automated chatbots.
Well, but then you can't find a phone number so frequently.
You can find their WhatsApp channel now and you can talk to that channel. That's what they're trying to do with their...
Is it a real person there, though?
No,
of course not.
I've got no time for that, Mandeep. I want to speak to people.
I totally agree. I absolutely hear you. I am curious. With respect to Meta going forward, how much of their earnings had to do with crushing it on the advertising revenue and how much had to do with the job cuts?
I mean, job cuts was a big factor, 25% layoffs. So they've already reduced their expenses $6 to $7 billion, and that shows up in the free cash flow. And they didn't cut anything on the Reality Labs side. That was the big surprise. They talked about raising their expenses on the Reality Labs front, so they're still going to lose $15 billion on building this metaverse again this year, and that's why the stock is not up more. Otherwise, I think investors would have cheered this print even more.
So you still think that deep down, Mark Zuckerberg's big hopes and dreams are the metaverse still?
Oh, absolutely. That was evident on the call. Like, he firmly believes in this. He thinks this will still drive the next leg of growth, but at the time he has course corrected, pivoted to AI, rightly so, and that's been good for the stock.
Can you describe it? What does he have in mind? What does he think this is going to look like?
Well, so he thinks once he has the install base, and he's very focused on building the hardware where, he can have the content and control that ecosystem. He called out Apple for thwarting, their innovation and changing the rules all of a sudden, which hurt $10 billion of revenue last year for Meta. And I think he wants to control that ecosystem. But with Apple Vision Pro launch, I think at least it has validated the market. I still think they are spending way too much without really establishing a business case for metaverse. I don't think it's going to be that next computing platform that he thinks. It's probably too far out a bet, and losing $15 billion every year, I mean, investors won't like it. But at the same time, he's growing top line 20%, so he may get a pass for at least 2-3 quarters.
Is he investing enough on the other tech innovations, in particular artificial intelligence, as he tries to lean into the metaverse with dubious application and, frankly, a dubious leg up on some of the other areas, other companies that are developing this?
Yeah, so they are open sourcing their large language model, unlike ChatGPT or, some of the other ones. And what they're saying is, since they don't have a public cloud, they're going to partner with Microsoft and really make that available for consumption. So it's a good way to go about, driving adoption. But I still think, with large language models and how they're going to be monetized, I think public cloud vendors are the best position, which is why Microsoft and Alphabet got a bump from that.
As Jon was talking about, in about a week's time after the bell, we're going to hear from Apple, from Amazon. Is the expectation that they'll similarly deliver the better than expected results that we've seen from most of the other tech giants, Snap not included? Is this basically a telltale sign that the rally has been justified by fundamentals?
I mean, in the case of Amazon, you could see ad spending getting a lift because overall ad spending has improved. But AWS, I think because of their lack of exposure to generative AI and the expectations are low, you're going to see a muted growth on that front. And Apple, look, we saw that from TSMC print. Smartphone demand is down. So I can't see how Apple beats on the top line. But at the same time, they still control the ecosystem, which Mark Zuckerberg doesn't like. And I think that's why they are where they are.
Apple earnings a week away based on our reporting. Maybe units this year are stable, don't change much from last year, but average selling prices are going to go up. That's the hope anyway.
The hope for who?
I imagine it
I was about
materializes.
to say, the hope for
the hope
shareholders.
for them and anyone who holds the stock.
Exactly,
At
not
the moment,
for anyone who's going to buy.
mine's a few years old and I'm not upgrading it. Unless they do that thing they do where they sort of press those buttons and come in and slow it down aggressively, and then I've got to upgrade it. But right now I want nothing to do with it.
I understand.
What am I upgrading to?
Better.
Maybe you can run your large language model on your phone.
Large language model.
No interest in that at all right now.
Well, I'm
a late adopter.
I know.
On pretty much everything when it comes to technology. Mandeep Singh, Senior Technology Analyst for Bloomberg Intelligence.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Lisa Abramowicz, and this is Bloomberg.